All right, stock started off on a down foot today, starting off the month, starting off the week, not so good, mostly because of Nvidia. Nvidia, as we talked about last week, excuse me, is the driver right now to the upside, and now as we see also to the downside. And it started a little bit last week with the earnings call on Thursday and the response that stock had afterwards on Wednesday night, and then Thursday's response. And then it continued today. And then a little bit of news in the after hours about an antitrust a letter being sent out. We'll see how much of a factor that has going forward. But it's putting a lot of pressure on equities just in general, and that's how market cap weighted indexes work. The biggest stocks in the index, the biggest sector, because of those biggest stocks, have the biggest influence on which way the market goes. And we'll talk about whether or not we expect this to be more of another downturn like we had in August and late July, or whether there's an opportunity. What signals might actually be showing that there's an opportunity for a bounce to occur here in the middle of the week. So we'll talk about that, talk about what's driving the action today, some interesting intermarket relationships showing up, and then our trade idea stock associated with Bitcoin that's also kind of breaking down. We'll talk about how to trade that stock. So let's go ahead and get started. Today is Tuesday, September 3rd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. Join our Market Outlook Facebook group that we've created. All right, if you're following us, or if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Click that like button there. I don't know why, again, it's not showing, but we'll figure that out. But again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who click on that day in and day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we had a down day today, but we came off the lows. So that helped bring the momentum line out from being oversold. We were extremely oversold at one point. So this is technically another intermediate confirmation signal. Now, again, it would be better if the near-term line were lower, and it was, again, until this late little rally. It shows how sensitive these short-term lines are to where we close relative to the low of the day. The low of the day at 54.04, so about 25 points almost off of the low of the day. So that brings those short-term lines up, so they're not nearly as oversold, and actually sets us up for a pretty good buy the dip signal here on this. Again, the combination of the red line being oversold, but only to a small degree, and then the intermediate line being strongly overbought. That combination is a bullish signal. Very short term, but a bullish signal nonetheless. And again, it would be better if we were forming a bearish low point with the near term line, but as you saw over here, that didn't really matter. We can bounce right up pretty quickly and bring the near term line up with it. So if we are going to get a bearish near term low, this is the first day with the near term line being outside, below 60. So if we're going to get a bearish near-term low, we got to get below 20 tomorrow. So again, unlikely that's going to be the case. It was likely before because the momentum line was down below 5 and the near-term line was below 50, and it was a lot more likely earlier in the day at the lows, but now less likely because of the low buy the dip we already had at the end of the day today. Nasdaq 100, of course, got hammered down over 3%. It did close a lot closer to the lows. But again, off of the lows there by about, quite a few points, from 18,958 to 18,869. So quite a bit, but granted, the Nasdaq was down 615 points. So in context, it wasn't that big of a bounce, but it was enough again to bring the momentum line out from below 5, and the near-term line still only slightly below 50 now. The intermediate line did turn over. We are below the moving average. That's a little different than the S&P. So we actually do have a light pink shading and a red line now. So we'll see how much longer that lasts. Again, the near-term line still not even in bearish territory. I never actually did get into bullish territory. Looking at the Russell 2000, it also had a pretty sharp down day today. Also down over 3%, below the moving average. So it wasn't just Nvidia, right? The near-term line did close down below the 5th percentile, just barely, but it closed below the 5th percentile. The intermediate line is rolling over, like the NASDAQ 100. The intermediate line is rolling over without getting above 80, which would be a pretty bearish sign if that were to persist. The near-term line did not maintain its position above the intermediate line, and it's bounced back down. Again, it's got 2 days to get from being above 60 to below 20. And so far, we got 1 day with an extremely reversal momentum line. So you can see these two charts kind of suggest more weakness to come, whereas the S&P is looking for a short-term buy the dip signal there. The Dow Jones Industrial Average is also showing the same buy the dip signal, right? The momentum line even more barely below the 20th percentile than it is on the S&P. Just there, it's 19.68. The near-term line, again, not below 50 or even in bearish territory. It has not been in bearish territory during this entire run that has been going up. So it continues to kind of oscillate here, excuse me, over the last week or so, up and down, up and down. Last couple of times we had down days, we bounced up, and you would expect to be the same. Until we break that precedent, you expect that would be the same. Or if we got more of a bearish signal, like a bull tag, which obviously we have not, since we're still a dark green shading and a green line here. Let's take a look at the weekly chart. This is kind of showing a potential for a transition candle. Again, we're only 1 day into a 4-day week because of the holiday, and but the weekly candle so far is bearish. We are still above the 10-week moving average, so we don't have the red arrow yet, which is bearish there. The PPO is falling. The size of the candle is obviously very small, well below its average. So again, it's a lower close. It's a transition candle. And we'll see if it actually transitions into something more bearish next week. But as of right now, you would expect it to, according to how again, just 1 day in, of course, to this weekly candle. Things can change if we rally really hard. The NASDAQ is forming more of a bearish candle. It does have the red arrow on that 10-week moving average, which is falling. The PPO also falling down there. The the size of the candle is actually below zero. So a little bit more of a bearish candle there, though. Again, still more relatively transition, more so because of the size of the candle, still more kind of in the transition camp than it is full-on bearish camp. Of course, your Russell 2000 is also forming a transition candle. Again, you can see as of right now, 1 day into the week, it is a pretty bearish candle. So you would expect it to actually transition to a bearish Heikin-Ashi candle next week if today's move holds, or if we actually happen to build on today's move. You can see the size of the candle back below its moving average. But again, no red arrow yet. So things are leaning more bearish, but not quite, full-on bearish there yet. We do have 3 red arrows on the NASDAQ 100. It's the only one that has 3 red arrows. The S&P only has the 1. The Dow still has 3 green arrows, and the Russell has 2, and that's how close the Russell is to having a 3rd. So again, one day of 3 red arrows doesn't make the trend. It's got to stay 3 reds for more than just 1 day for us to actually get a pullback. Otherwise, it's a really good buy the dip signal, and we'll see. Even 1 arrow can be a good buy the dip signal, as we've seen here, and you eventually had 2, a second one to help. We'll see if that's, as of right now, we kind of have to lean towards the buy the dip opportunity until we get something that tells us not to, right? Not to expect something different. When you look at the 2-line versions, we broke slightly below the 17-day moving average. The MACD is also below its moving average. The stochastic still easily in bullish territory. So again, some signs of weakness, though not, obviously we're not bearish yet because the MACD is still above 0. And the stochastics, like I said, still easily in bullish territory. So we're still bullish, but a sign of weakness when you have that combination of a close below the 17 and a close below the MACD. But the nice thing is we didn't close below 17 and the 30 at the same time. The Qs did close below the 17 and the 30, that 8 too for that matter, and the 50 for that matter, all on the same day. So it crossed below multiple moving averages here after closing above all of them on Friday, closing below all of them, including the 30-day today. Of course, also breaking below the MACD, breaking below its moving average. That's why you have a red arrow on the histogram, and that's how close you are to the MACD itself crossing below. And the stochastics is out of bullish territory, so a little bit more of a bearish pattern on the Qs than what we see on the S&P. Same with IWM. It also crossed below the 17 and the 30 at the same time. Has not caught that red arrow yet on the MACD histogram, and you're still relatively in bullish territory, still above the 50-day average, still above the point of control at the 200-day. So the Qs are the same way. The point of control is at its 200-day moving average as well. So any pullback as of right now would be limited to the 200. Now you break that support, things can get a little bit dicier, but you always expect support and resistance to hold until they don't. And so you would expect any pullback to be limited to that 200-day moving average because of that extra layer of support there at the point of control on the value area. Here's the DMI. You can see the negative has crossed above the positive. The positive has crossed below 20, but the negative line has not crossed above 25 yet. So your ADX is still low, and we still don't have the sign. That's not the case for the Qs. We have crossed above 25 on the negative. We've crossed below 20 on the positive. So that is a bullish. Your ADX has turned higher. That is a bearish signal, excuse me. IWM, the negative indicator, and both the positive and the negative are below 25. So still no really significant trend. In fact, your ADX is actually still falling there on IWM. Take a look at the RSI and the CCI. We are still okay. We're above 50. You're above negative 100. We haven't broken below any bearish levels yet here on the S&P. The NASDAQ did. We are still above 40 at least, but we're below 50 now, and we did break below 150, minus 150 there. If you look at the weekly chart, again, we did break slightly below minus 100, and we never did bounce back above 100. So we're still actually in kind of a bearish mode from what we saw a few weeks ago at the beginning of August on the weekly CCI. Your Ichimoku cloud, you are still above the cloud despite dropping below that 9-day mid-range point. The weak bullish trend that we had has gotten even weaker, but it's still there. You still have a positive rate of change, so we haven't really lost the bullishness yet on the S&P. We have broken below the cloud on the Qs. You have the very, very beginning stages of a weak bearish trend, and you can see the rate of change is kind of pretty much at zero right now over the past 26 days. If I were to take a look now at the Bollinger Bands and the Keltner channels, you see the band width is starting to falter a little bit as the bands are moving towards each other. We are in the lower half of that wide bandwidth, though just barely. And you can see the momentum, which is so extremely bullish, has turned slightly less bullish. So, but definitely has not turned bearish yet. So no issues there on the S&P. On the Qs, that bandwidth is also falling. We're also in the lower half, though not in the lowest quartile. And also you have strong bullish momentum that is just starting to wane a little bit. So again, because of how big the bandwidth is, we can get big moves and still not be trend changing. And as of right now, you would have to say that today's move is still not trend trading, and we might lean more towards buying the dip than not right now, knowing that there are weaker signs on the Qs. But until we see some more bearish signals on the broader index itself, we'd have to look for the buying the dip opportunities here. You can see we did close below last week's low. So that's the first. After closing at the 2-week high point that we've had in this 2-week range that we've been in, the closing there on Friday, we closed below last week's low, and you can see there's not a whole lot of support below us. So that's a little bit of a concern. The Qs clearly closed below last week's low, but they also had traded below the week before's low, so they're already showing some weakness. You can see the Qs are setting ourselves up for a bearish crossover as the green line is crossed below 70. IWM, remember, had both lines below 20 before the breakout. But then it got a one touch, and it looks like it might just be a one touch, which would make it, you can see a trend line you draw across here. We have clearly broken below that trend line. If you look at today's range and volume, we were above average on the range. You can see 11 points there. Here, let's go to this one. 11 points. Again, not including the gap. We had a little bit of a gap to the downside. In fact, the gap to the downside here was slightly more than one standard deviation, and then we ran away at the open, ended up with a 2% decline. So could be a runaway gap. The Qs was worse, right? The Qs did not quite have a one standard deviation gap, but ended up with a 3% loss, which is obviously not very common. We've had recently in August, but not common during a bullish trend. But when you look at, again, the range and the volume, the range over 11 points, the volume over 60 million shares trading hands. So when I look at those two numbers in context, 11 points is way up here off of the ATR chart. So it's bringing this back up to levels that, again, that we're typically at when we're in pullback mode. And the volume, again, is up above the average, which had been declining pretty sharply over the past couple of weeks. Of course, more days like that, we need to get the volume back down. We need to bounce back up, get the volume back down for us to kind of avoid that line starting to turn up higher, considering the last 2 days have been pretty heavy on the volume. Finally, the VIX jumped up pretty sharply today, got all the way up to above 20, finished above 20. It was a 38% gain. It's one of the bigger gains in the VIX that we've seen. Of course, August the 5th was a bigger day, but that's the only other day that's on the past year that's been bigger than this. If I were to go back, 5 years, you can see before that, the Thanksgiving, like in 2022, we never had a big one-day move, and all that correction, we never had a 30% gain. And this would be a 30. Let's just put it at 30. We never had a 30% move or higher. We did at Thanksgiving when it all started, and that correction started there. And you can see some other instances there in early 2021 and 2020 in June 2020 and the COVID. So again, not common to get a VIX move that big in just a single day like this. We got above 20. We barely got above the 95% mark. But this is the scarier part. The VVIX jumped up to about 130. And again, when the VVIX is high, it sets us up for the big VIX move. So unless we really falter back down tomorrow, and you can see the breakout that we had, the VIX above its average values over whatever time frame, it's a big move higher. The high VVIX opens the door for more of a move to the upside on the VIX in this week. So that's something, again, by the dip, that VIX should drop right back down over the next few days. But we need to keep that door, and that's what I lean to. But I need to keep that door open to that possibility that the VIX can jump, because the conditions are there for the VIX to jump again sometime this week, if not tomorrow. If we consolidate a little bit tomorrow, if not then more likely in the middle to end of the week here. All right, now let's take a look at what's driving the price action today. As you can see, commodities and real estate have been diverging in opposite directions by a 20-point difference between the two over the past 3 months. If you just look at today alone, let's go 5 minutes, you can see a big drop in commodity prices, big drop. Started off down 2%, finished down 2%. Everything else kind of joined them. Of course, IWM and the Qs both down 3%. Gold is down 0.5%. The dollar is up a little bit. Yields were down. Bonds were up quite a bit. That's a big change for bonds. If you take a look at it here, let's take a look at TLT, and you can see it had been coming down. A big breakdown on Friday, only to rebound right back up to the upside. So a big move up. As was mentioned, the dollar had a little bit of a move to the upside, but again, not very much of one, and it's still kind of holding there at the 17-day moving average. The dollar's kind of in this catch-22, because a move to the upside typically is associated with weakness in equities, but a break below 100 is probably going to end up being weak too, because that will mean currencies like the franc and the yen are strong and pushing the dollar down. And so it's kind of in this catch-22 situation where a move down to 100 is actually pretty bullish, but going past 100 is not so much. And you can see also too, the dollar is already below, or flirting with getting below its 200-week moving average, which again would be kind of the same thing. It would be a significant break below a key level for the dollar, which would mean a significant increase in the Japanese yen, which the Japanese yen, remember, is the carry trade that sparked all the weakness there at the end of July, beginning of August, and we're struggling to rebound and potentially breaking back down, which there's a lot of room for this to go down. The yen is way oversold relative to the dollar in the past 20 years, so there's opportunity for it to really break down hard, which again you would consider, like in 07 and 08, to be a bearish thing when the yen is outpacing the US dollar. The yen is kind of the ultimate safety trade because of its low yield, way more than even the dollar is. Big move lower in breadth today, as you can see. The McClellan oscillator dropped down to almost negative levels, got down to less than 2. So pretty strong levels previously, breaking down to negative, or to less, like I said, less than 2 there. If we take a look here at the new highs and new lows index, so the number of highs in the NYSE dropped to below 200, but still above the moving average, so we're still okay in that regard. The numbers of new lows really jumped up, not just strong levels, but above its moving average. So relatively strong move. You can see the new highs and new lows dropped down to close to their moving average. So still positive, still above the moving average slightly, but obviously down from where they were going into the weekend. The number of stocks above their 50 and 200-day moving average, you can see we jumped back above 1. That's not a good sign. So we really want this to be very temporary. We're still at relatively bullish levels. We're still above 70%. They're at 359 stocks above their 50-day moving average. Number of stocks above the 200 is still relatively high above their moving average too. You can see the 50 were above their moving average as well here. The moving average is up to 338. So we're doing okay. Weakness, but nothing trend changing yet to the downside. The big key here is just how bearish XLK is doing. I mean, look at that big drop in XLK. It's already been underperforming. The momentum now has dropped below 100. Of course, the big reason for this is Nvidia. Nvidia is dropped below its 17-day moving average. The 8 days about to cross below. We have really crossed. The ratio has dropped below its 50-day, as its relative strength and momentum is dropping again. Really, really important for XLK to outperform, because that's the biggest sector. That's where Apple, Microsoft, Nvidia are. They need to continue to outperform for the market. All these other sectors that are all moving up to the right, they're all negatively correlated with the markets. Like for financials, for example, if I were to take a look at financials here relative to SPY, you can see it's got it's pretty flat now. The correlation's pretty minimal, but it is, and you can see the ratio is really breaking out to the upside. But generally speaking, it's been pretty negatively correlated. And now you have the RSI at 70. Last time at 70, that's kind of where it peaked. You can see the MACD is pretty high, about as high as it was over here. The CCI is really high. The DMI down there at the bottom, really extreme to the upside there on the bullish side, and like I said, the RSI. So you had some really good outperformance in XLF and as well as some of these other, healthcare, real estate, staples, all these safety trades. Utilities is still kind of lagging, but turning up to the right. These are all safety trades and all starting to outperform. And again, not necessarily the sectors that we really want to outperform right now. All right, that brings us to our trade idea of the day, and it's Coinbase. I want to take a look at Coinbase here. Coinbase has been in the bearish trend. It started to try to recover, but it's rolling over on a new leg lower to the downside, dark pink shading and a red line. We are below the 5th percentile of how far below the moving average we are. The intermediate lines failed to cross above the market sentiment line. They're both falling in bearish territory. Short-term sentiment's bearish. You can see the weekly chart is got a bearish candle as we break below the 200 week. So it looks like, again, we're close to a death cross. We've been pretty bearish to get to this point, but you can see from a long-term perspective, we're actually not that we're not where it looks like we're kind of just starting. You can see we're below the 200-day. Not a whole lot of room to the, not a whole lot of support to the downside here. There's the 50, and we don't have enough to get a 200-week moving average, but again, you can see all the lack of support till we get down to about $100. The MACD is just turning negative. The stochastics is dropping into bearish territory on this weekly chart. Let's look at some of these other oscillators like the DMI. You can see we're breaking up above 30, below 10 on the negative indicator. If you look at the RSI and the CCI, they are also both at bearish levels, below 40 on the RSI, below minus 200 on the CCI. The Ichimoku cloud, as bearish as we are, appears to just, we have a mature bearish trend going on the daily chart. On the weekly chart, you can see we're just starting to break below the cloud, so we don't have enough data yet to have the trend quality indicators down here, but you can kind of see negative. We've turned negative on the rate of change this week for the first week, and like I said, breaking into the cloud for the first week as well. Finally, looking at the Bollinger Bands and the Keltner channels, we are breaking below the lower band and the lower Keltner channel with the bandwidth really low, starting to turn up. So there's an opportunity for a downside move here. So what I decided to do was to sell the mid-20s delta, buy 155. That puts your maximum gain at about a little bit more than 1.5 to 1 reward to risk ratio, almost a 2 to 1 reward to risk ratio there, which is not too bad. And that's how much flexibility, considering how bearish again we already are. I got a little bit of flexibility in terms of timing there with that much to work with. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us on MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.